So good morning, everybody. I want to continue on chapter 14, and I'm on slide 18 here, as you can see. And basically, there's a common methods. If you want to repurchase, if a company wants to repurchase shares, they simply do an open market share repurchase. This is one of the methods, right? And they simply buy back some of the outstanding shares on the open market. That's all it is. That's simple. All right. The second way is a tender offer repurchase, and that's a repurchase program in which a firm offers to purchase a fixed number of shares, usually at a premium relative to the market value, and shareholders decide whether or not they want to sell back their shares at that price. So this difference from the previous one is they have a premium relative to the market value, and then there's a Dutch auction repurchase. And that's a method in which the firm specifies how many shares it wants to buy back and a range of prices at which it's willing to repurchase the shares. Investors specify how many shares they're going to sell at each price in the range, and the firm determines the minimum price required to repurchase its target number of shares. So the minimum price will be determined by what people are willing to pay. So in the end, when they determine the price, all investors who tender receive the same price. So it's a Dutch auction, it's called. All right, so let's look at this. In July 2013, this is a good example. Fidelity National Information Services announced a Dutch auction. They want to repurchase $86 million shares of common stock at a price that ranges from $29 to $31.50 per share. All right, and here's the offer price, right? And here's the number of shares that were tendered, from 5 million up to 20 million. And this gives you the cumulative total here, right? 5 and 10 is 15, and another 15 is 30, and 48. So at a price of $31.25, right here, shareholders are willing to tender a total of 86 million shares, exactly the amount that Fidelity wants to repurchase. So you can look right here and you'll see it says 86 million shares, and that's what they originally want to repurchase right here, 86 million shares, right? So the price will be set at that level. All right, so there's different tax consequences whether or not you collect dividends and do share repurchases, but the tax laws change all the time. So you can go through this and see. Here they talk about the American Taxpayer Relief Act of 2012, and this is where they extended the 15% tax rate on capital gains and dividends. I don't know what it currently is, though. I do my taxes electronically, but it's easy to find out what the current tax rate is. All right, so here's a personal finance example. Espinosa Industries on the current year, October 4th, declares a quarterly dividend of 46 cents per share, payable to all shareholders of record on Friday, October 30th. They set a payment date of November 19th. Rob and Kate Heckman, who purchased 500 shares of Espinosa's common stock on October 15, wish to determine whether they will receive the recently declared dividend, and if so, when and how much they would net after taxes from the dividend, given that the dividend would be subject to a 15% federal tax. So they purchased 500 shares, right? And the quarterly dividend is 46 cents per share. So given that Friday, October 30th is the date of record, the stock would begin selling ex-dividend 2 business days earlier, right? On Wednesday, October 28th. Remember, 2 business days. Anything after October 28th, you don't get a dividend. Purchasers of the stock on or before Tuesday, October 27th, would receive the right to the dividend. Because the Heckmans purchased the stock on October 15th, they're eligible to receive the dividend, right? It's before the 28th, right? And it's 46 cents a share. Thus, the Heckmans will receive $230 in dividends. 46 cents a share times 500 shares should give you 230. And it doesn't have to be mailed, right? My account, it's electronically entered, and then I buy additional shares. And then, of course, they have to pay their 15% federal income tax. So if you take their, on the dividends, if you take 230 and take off the 15%, they'll net $195.50. Basic example on how to deal with dividends, and we all have to deal with that. All right, these things, as I just mentioned, are called dividend reinvestment plans. When I get dividends, they buy additional shares. That's all you really have to know about that. It's a good deal. So what happens to the stock price when the company pays a dividend or repurchase shares? When a stock begins trading ex-dividend, the stock price should fall by exactly the amount of the dividend. In theory, when a firm buys back shares at the going market price, the market price of the stock should remain the same. So in practice, taxes and a variety of other market imperfections may cause the actual change in share price in response to a dividend to deviate from what we expect in theory. So in theory, the price should drop by the amount of the dividend, but that doesn't always happen. This is all very theoretical, when they talk about the price going down. All right, so the big question about paying out dividends or buying back shares, and this is the most important question right here. Does the payout policy have a significant effect on the value of a company? So when it pays out dividends or buys back shares, does the value of the firm change? And there's a bunch of theories, and that's all they really are. There's the residual theory of dividends. Suggests that the dividend paid by a firm should be viewed as a residual, and the amount left over should be after all acceptable investment opportunities have been undertaken. All right, so basically there's 3 steps involved with what you're dealing with a dividend, right? Determine the optimal level of capital expenditures, which would be the level of that exploits all of the firm's positive net present value projects, and use this optimal capital structure proportions to estimate the total amount of equity financing needed to support the expenditures. And because the cost of retained earnings is less than the cost of new common stock, use retained earnings to meet the equity requirements determined in step 2. So basically, if you want to know why the cost of retained earnings is less than new common stock, go back to, I believe, chapter 8 or 9. So if retained earnings are inadequate to meet this need, sell new common stock. If the available retained earnings are in excess of this need, distribute the surplus amount, the residual, as dividends. So they make a decision whether to issue new stock, to use that to pay dividends, or use the retained earnings. All right, so there's this other thing that the dividends are irrelevant to the value of the firm, and this is Miller and Modigliani's famous theory that the value is determined by the earning power and risk of his assets, and not by whether or not it pays dividend. All right, so there's a whole bunch of other arguments. Dividend relevance theory, and this was advanced by Gordon and Lintner, that there's a direct relationship between a company's dividend and its market value. And there's this term, the bird in the hand argument. And this just simply states that it supports the support of the dividend relevance theory, that investors see current dividends as less risky than future dividends or capital gains. And there's been a lot of studies done, so you could go over these studies. Large changes in dividends do affect share price, but there's all kinds of theories that go back and forth. All right, so there's a lot of things that affect whether or not a company pays dividends, and this is the big 5, right? 5 factors in establishing a dividend policy, and there's legal constraints and market considerations, and the board of directors makes a decision based on these 5, whether or not they want to pay a dividend. So here's the legal constraints. And you can go through this example. This basically determines the legal capital includes all paid in capital. The firm could pay out, only $140,000 in dividends here because of legal requirements set up in the state. All right, so there's another thing, whether or not there's going to be growth. A growth firm is likely to have depend heavily on internal financing. So it may not pay out dividends, or may only pay out a small amount. Such that, like I said, AT&T and Verizon pay out 5% dividends. They're established. Google doesn't pay a dividend. All right, so there's more on dividend policy theories here, and there's a catering theory. Okay, so these you can just read. If you have any questions, email me about these different theories. Right, and there's a ratio that you probably would have seen if you were in 330 when I did all the ratios, or another professor did the ratios. This dividend payout ratio indicates the percentage of each dollar earned that a firm distributes to the owners in the form of cash. It is calculated by dividing the firm's cash dividend per share by its earnings per share. So it's basically the dividend divided by the earnings, and it gives you this ratio. And again, you can go, I believe Chapter 3 has all the ratios, and this will probably be in there. So here's an example of a policy of paying out 40% of earnings in cash dividends. And in periods when a loss occurs, the firm's policy is to pay no dividends, right? So here's the earnings per share. So take 40% of this and you'll get $1.20. Just keep taking 40%. You'll notice that when this is negative, they don't pay a dividend. That's all. So it's just simple math here to find out what the dividend. And notice here, this was earnings, so there was no dividend. And over here, 40% of $4.50 is like $1.80, right? All right, so as I previously mentioned it. There's a thing here called extra dividend, and that's an additional dividend optional paid by the firm when earnings are higher than normal in a given period. So you could look at this, right? And as I said, Apple paid me an extra dividend a while back. A lot of times companies have tons of cash, and they'll pay an extra dividend. Costco just recently did that. All right, so I'll leave that there, and we'll pick up from this point later. Everybody have a good Saturday.